Hello, everybody. Adam Parks here with another Receivables webinar. Today, I'm very excited to have such great guests here to talk to us about student loans. Where do we stand? What's happening in the student loan space? And let's get back to some history here as well. So for those of you that know me and are watching our content, you probably have seen Mr. Dan Parks and Mr. Andrew Black in the past, who are with Yrefy and have a lot of experience working in the student loan space and are currently refinancing student loans for people all over the United States. But today I've also got Mr. Gary Hopkins joining us as well, who formerly had been with the Department of Education and is just an absolute wealth of knowledge for this industry. So to get things kicked off here today, could you guys start by, let's start with you, Dan. Could you tell everyone a little bit about yourself and your background?
Yes, Dan Parks, obviously. I've been with doing student loans literally probably for 40 years. A wealth of that has been on the federal contracts, but it's also been with working on every private ones that has gone through the Phelps, all the agencies that worked with the states. Been doing this for a long time. Been with Yrefy for the last 7 years, where we're originating private distressed student loans. Andy, have his go, and then we'll go with Gary,
Andy,
the
we'll
star
just
of the
work our
show.
way through it.
Cool. So, Andy Black, I'm with Yrefy. I'm the general manager here, overseeing our operations and helping borrowers get right with their distressed private student loans. My history was in Department of Education, working federal contracts and federal subcontracts. So, did that for about 20 years before coming to Yrefy. So, been at this a while and don't have the experience of these two gentlemen I'm with, but trying to keep up.
I think that's our job today, Andrew, is to kind of keep up with these guys and try and soak in some of this knowledge. Gary, you've got kind of a storied career, as much detail as you're want to go into. We're happy to hear it. Could you tell everyone a little bit about yourself and how you got to the seat that you're in today?
Gary Hopkins, over 30 years doing student loans and really been all sides of it. Worked with guarantor. I was actually with Texas Guaranteed Student Loan. I've worked with private collection agencies and also with the Department of Education, managing the Department of Education's portfolio of not just direct loans, but FFEL loans. Was the director of all student loan repayment through about 2008, and then went back out into the private industry and worked with a contractor, helping out with managing the we used to call it the back end, the repayment stage of student loan, but fell direct, all sides of it over 30 years, pretty much seen just about everything that happened in the last 35 years in the student loan.
Well, I can tell the audience that just since we were sitting here preparing for this session and getting all of the technology connected, I learned more about student loans in the last 20 minutes than I've learned in the last 20 years being in the debt collection industry. So I'm excited to kind of go through this with you guys today. So I'm going to nerd out a little bit here because I don't know all that much about student loans and I really want to learn. So let's talk about the timeline of student loans and how that's changed. I know that we've talked about some of this in the past on previous webinars and podcasts, but I'm just going to float it out to the group here in terms of discussion. But can you guys give me a little bit of insight on how did we get to where we're at today? What has this looked like? I mean, I know there's been a lot of activity since 2024, but even going back before that, what's the history of student loans?
Yeah, so I guess in the present context and what we're talking about would be started hearing 2020 loans were put on March 2020, loans were put on hold for COVID. And then effectively in 2020, everything we heard about student loans was loan forgiveness, really challenging people's focus on how to deal with this or how to prioritize, how to borrow going to school. You had several programs that there were stoppages, repayments, you had privates restarting, federals not, and people trying to figure out when was the real time to start paying, but consistently being overshadowed with the concept of forgiveness. And when you look at forgiveness, for most people, they look at student loans as the all-encompassing student loans, not separating federal loans from private loans. Three things started to get a little bit more exciting when we put out the SAVE program. The Department of Education introduced radical reduction to income-based repayment options when the forgiveness proposals were effectively struck down. We began the on-ramp program in 2023 with the credit bureaus giving borrowers time because payments were due in the end of 23 And the bureaus gave customers about a year to get right, and they weren't reporting delinquencies. So the servicers were supposed to be working with their customers. They were supposed to be staffing up more people to be able to manage the calls and the influx. October 24, credit bureaus started reporting again and been showing delinquencies increasing over time. And May 5th, the reintroduction of garnishments or of collections, we'll say, right? Garnishments just part of the collection process on Department of Education loans. Really facing some troubling numbers when we think about where borrowers are sitting today and how many more delinquencies we have today, 90 days plus than what we had pre-COVID. So double really what was there before COVID.
Yeah, I want to say from the TransUnion report that we were reading recently, and I'll drop it in the chat here for those that are watching, it was 50.8% of subprime consumers were currently delinquent. I mean, that's insane. That's insane for the largest loan servicing platform on the planet. Like, that is the largest.
Well, it has a lot to do with the mixed messages that were coming out. A lot of people just even their loan payments that they were making got sent back to them. Out of sight, out of mind. When you're 20-something-year-old person, or even, a large much of these is, you get an extra $400, which is what the average payment is on a federal government. You start spending it somewhere else. And now that it's came into being, you're either can't see me, or you got that money being sent somewhere else. You got a new car, you upgraded to a four-wheeler or something, and it's not there, and put people in a horrible situation.
Yeah, we want to remind everybody that no one has made payments on their student loans for 5 years. The pandemic got there and it just stopped. But as these gentlemen were saying, that it was a total change in direction in terms of even asking anybody to pay. As Dan mentioned, there were some payments that were even returned. So I don't know how far back you want to go, but
I want to go back, Gary. I want you to bring us.
Gary
I want
could
you to
bring it
give us the
back.
historical context, because that's what's we can't understand where we're going if we don't understand the history. So as
Well, one
far
of the
back
most
as you're willing to
significant-
go, I'm willing to listen.
One of the most significant changes I believe is made is just in the sheer volume of the portfolio. We've heard it reported a lot. I like to tell people, at the time that I was director of all student loan repayment with the Department of Education, direct loan volume was only $110 billion. And by 2010, it had grown to 230. And that's when direct loan took over 100% of the student loan volume, and the Federal Family Education Loan Program was limited. But we went from 230 billion in 2010 to well over $1.5 trillion in just 10, 11, 12 years.
And that's federal.
Transition just made everything explode. So then everything is magnified, and that's really when you got the administration will be able to say, hey, these things are a burden and nobody should have to repay. But that transition, I absolutely believe, was significant.
So how are we ever going to slow this issue? And we're talking about massive delinquencies and charge-offs in the pipeline. We're talking about all these challenges. But the one thing that I'm not hearing in the news, and I'm curious to get your thoughts on, is how do we actually curb this issue going forward? The cost of education is rising exponentially, and the value of education is plummeting at the same time. I don't know about y'all, but I don't even look at college education anymore as a qualifier when hiring. It's just not even in my equation any longer.
That's an element too. That's an element too of the growth. I mentioned the growth in the portfolio.
Yeah.
Cost of education is probably one of the biggest driver, and you can make the case that when there's an unlimited amount of money available, then there's no check on the increase in cost.
Nobody's
Until
underwriting it at that volume.
So I
Well,
believe there's the
Te-
House
technically
Education.
speaking, the federal government is underwriting it.
They've done such a great job with medical that I just want to trust them with all of my banking needs.
As you're right, Dan. Ultimately, the taxpayer is underwriting it.
Wow. So, I mean, there definitely seems to be some challenges there. Now, Gary, one of the things that you mentioned as we were kicking off here was that you were with I believe it was the Texas Guarantee, which was when the student loans were happening at the state level. Can you talk to us a little bit about what that transition was like from that, at that point in time in which we kind of moved from those types of organizations into the federal lending programs?
Well, of course, there was a time where FFEL was the only loan program, and if you want to go to the start of it, it actually was a Republican that first spoke of the direct loan program. It was George Bush, the first one.
Yeah. Okay.
And Bill Clinton was a big fan. And for years, they were pushing direct loans as an alternative because it would save a lot of money. The guarantors, that process, it basically worked like an insurance company. The private lenders would make the loans, borrowers would pay a guarantee fee. And if the loans defaulted, guarantors would reimburse the lenders, and then they would in turn, be reimbursed by the federal government, depending on their default rates.
Subject.
The federal government, many people in Congress got to the point where they felt like, hey, we could save a lot of money if we cut out the middleman. The private lenders are making too much money off this. There's too many people making too much money. And in
There was so
typical
little
government,
risk for the, like when you think about the original Sally Mae, people like that, they really had a risk-free model. They signed up the loans, gave the old Sally Mae when they were doing these FFEL loans, but they gave the money that if they didn't pay, okay, somebody else paid me back. So it was a money printing machine for a very long time.
They didn't share in much of the risk. Things kind of evolved. It got to the point where, depending on your default rate, the amount you got reimbursed went down. You started at 100 and would go down depending on your
Subrogated.
default rates. But the reason, let's remind people that the reason that the subsidies were there, and this may be the biggest problem, is that lenders were loaning this money out without any credit check at all. So they didn't score them. And the federal government felt like, as an incentive to get the lenders to loan this money out, we will subsidize it. So that was the thinking behind it, is that,
Yeah, give them incentive to want to do
Am I
it.
crazy, or does this sound a lot like mortgages in 2006 and 7?
There's a lot of similarity.
yeah. And it was, but the time it wasn't sold as, hey, this is a great loan. It was actually presented, hey, you're loaning to people who are not credit worthy. They're 17 and 18 years old. They don't know anything about debt. We're trying to promote education. That's why we're subsidizing. So in that sense, they knew what they were doing. This wasn't one of those that they presented it some other way, but it was an attempt to loan money, give people a chance to go to college wherever they wanted to go.
Is there any opportunity to balance that cost of education issue, or is there any way to start underwriting that or to modify these programs into the future to protect the future of the program itself? Because I love the idea of providing the opportunity for those to get educated. How do you, can you build, is it feasible or realistic to actually build rules around?
So that was we recently, something got cleared through the education committee where it was a plan kind of trying to reshape how loans will function, trying to combat tuition inflation by limiting spends, holding institutions accountable for the student outcomes and repayments. So not giving them as much money. The schools, you talk about wanting schools to be able to clearly state what the costs are and what the return on investment. So the average income for the people that complete the degrees. And I think even just simplifying repayment options, we're not doing any services by having something as big as the millions of people enrolled in SAVE who are on a forbearance and can't do anything with these loans. The repayment options just aren't simple. You could link today, you can't, but you could link together, make it all income driven, come up with a more appropriate percentage and share your tax information so people don't have to individually recertify every year. Some people don't like the government sharing information between entities, but make it simple for people. And I think that would help prevent just the confusion around the process. I think there's some of this is willing and some of this is consequence of lots of different noise and lots of information coming from different places and nothing being consistent. There's just no single clear path for a student today.
That's an interesting challenge. Go ahead, Dan.
The American people are a consumer. They're just monsters. They want to get in or whatever it is. We do zero. They say they do, but they do zero education on exactly explaining, hey, you know what? If you go get a teacher's degree from some private student loan where you're going to walk out with $150,000, we do a ton of here at Yrefy. We do a ton of teachers loans, a ton of them, and it's amazing how many people went to a private student place and got a $150,000 teacher certificate. And now they're working, here in Arizona, they're making $45,000 here to start. Now you keep making more a piece. Still, it wasn't a good
Wasn't a good
ROI for them.
investment.
It was not a good ROI for them at all. But yet they wanted to do the college experience. They wanted to go get 4 years. They went to, maybe mom or dad's college, or, somebody that went somewhere to get an engineering degree where that might make sense for that $150,000. But, I don't want to diss on anybody that's got a sociology degree or a teacher degree or something else. But as a general rule, those aren't going to pay enough for you to stay ahead of your loans unless you have somebody else helping you or invested into you earlier for your schooling.
Adam, let's make sure we understand who the loans are marketed to, these people. I used to go to colleges all the time and speak about some of the things that Adam told me, limiting the amount you borrow, being careful. I would even show students, I would go talk to senior classes and show them, if you borrow this much, this is what you're going to have to repay. This is what your repayment amount is going to be. But let me tell you something, because we've always done the education to borrowers. They've always been required to learn about the loan and everything before they take out the loan. But we're asking 18 and 19-year-olds who are not mature yet, we're asking them to make smart financial decisions when they haven't reached that level yet of maturity. All they know is, here's somebody offering them money, and this is the way they go to school. So regardless of what the terms are, they will accept that. They will say later that they had no idea it was a loan, they thought it was a grant. You hear all that stuff, you still hear it. But my experience in speaking to them, as forcefully as I knew how, it was going right over their heads. They're 18 and 19 and 20. They think about it when they're 30, but at 18 and 19, it's, where do I sign? You're going to give me $25,000? Where do I sign? Especially when you're not limited to only using the loan money to pay your tuition. You can use it for other things.
Do you think that part of that in their decision-making process is related to their disconnect between the realities of what they're going to earn in the future? Meaning, like, it's, I'm going to college, I'm going to have a job, paying back $500 a month won't be a big deal when I have this great job. Do you think part of that is just offsetting it, or is it just it's an age thing? They don't understand the time value of money yet.
There's some of that, but I think it's even simpler
Okay.
than that. I want to go to school, and
want the college
I don't
experience.
care how I pay for it right now. I'll worry about that later.
Okay. It's the okay.
I want the college experience.
Yes.
I've watched it on TV. I've seen it glorified. I want to do that. I want to go to Animal House or whatever. I'm going to date myself by saying
Or
that.
I want to go to this big private school I've always wanted to go.
Mhm.
The only way I can go is to borrow this money. And you have financial aid offices. That's why they're there. They help them put together these packages. This is how you can go.
And you look at a final disclosure.
But you can also go here to borrow. You can go here to borrow. And if you're a 17, 18-year-old and your parents are telling you they can't help that much, where do I
Still
sign?
want what you want, yeah. And I
Where do I
look at
sign?
some of these disclosures from what the borrowers signed for originally, and you look, and it was $73, no big deal, right? And you sign these all separately, one at a time, and you're taking out all these progressive loans. Well, that's what it would be today if we started repaying, not when you take 7 or 8 years to start your repayment cycle. And now your $78 is $110, and you have 8 of those loans. You weren't prepared for that. You were signing for these nominal amounts on these longer terms, and it's easy to let that get away from you when your eye isn't on the total, right? You're sitting down signing one paper at a time.
Unless you went and got the right degree, a lot of these loans that these people took out are forever loans. They will be paying them forever.
Well, look, I'll pay mine forever. Andrew, what you talk about with the stacking of those loans also reminds me a lot of what I'm seeing in the buy now, pay later marketplace.
You
Sure.
are.
And people are.
That's exactly what you say.
Mhm. And that's exactly what we're doing. It's buy now, pay later. That's what the education is, right? Like, it's the investment in the future. And I think we need to have a strong loan program for everybody in many walks. And I think education is our pathway to success as a country and as for an individual. I don't want to see those things go away.
For everybody.
Right.
But what you're seeing is, I mean, just to put it in perspective, they don't know, they didn't pay attention. Only 50% of the phone calls that we get at Yrefy are for federal loans, if not more. It's people calling in, even though everything that we advertise and everything we do has the word private in it as many times as we could put in there, because we really don't want to handle those calls. But being the way we do business, we try to direct them in the right place, you know, to help them out, so that maybe they'll tell somebody, hey, that Yrefy helped me out with my federal loan, sent me to this place, helped me out. If you got a private one, give them a call. But it's amazing. It's amazing how many phone calls that we get, you know, that we're helping get them to the right direction. So that's just a microcosm of what we're giving loans to, who we're giving loans to.
So we've talked a lot about the history of the student loan marketplace, kind of how we got to where we're at today in terms of this buildup of volume. Let's talk about our current fiscal situation with what we're actually facing today. And I did put out into the chat the newsroom link from TransUnion that I was reading and that we had all kind of shared and talked about previously. So if anybody has questions, feel free to add those directly to the comments. I'm going to be monitoring that throughout the presentation today. But as we talk about where do we stand today, guys, like what is the current state of student loans? And I know that that is all in flux, and at this point all we can really do is speculate based on our historical knowledge and best guesses. But talk to me a little bit about what you're seeing in that marketplace right now.
I would start by just reminding you again that until we got to May 5th, nobody has made a payment on student loans in 5 years.
Turning back payments is the craziest thing I've ever heard.
Start the discussion there. No one has made a payment. No one's made payments in 5 years.
It wasn't even that. We sent them back their payments, and then we said, you know, we had, what did we have, 5 TIVAs, which are the people that were servicing these accounts. And then we went down to 3 because we weren't paying them very well to handle these calls. We sent them back their payments, and then we tell them you're going to have to reach back out to make the payments. But the problem is they'd be on hold for 12, trying to get a hold of somebody to go make their payments back again. And how many people are going to have the audacity to keep trying to get through to somebody? It just perpetuated itself. So then they, you know, now I got this extra $400, I'm going to go spend it, which I said earlier, you know. It was rough. What we did to the American student parents is rough.
It was a disservice, really.
A disservice.
Well, it's. I'm not trying to defend the government here, but every change that you've seen, I think back to even since 2010. I'm gonna go back to the history again. The transition from FFEL to direct was supposed to help everybody and help the program. The promise of going to 100% direct was that costs would go way down. As a matter of fact, the CBO estimated that the federal government would make money by eliminating FFEL and going to direct because of the interest rates. The interest rates where they were at the time, interest rates on loan was more than what the federal government was having to repay Treasury for it. So as long as people stayed in repayment, then the federal government would actually make money. They didn't anticipate that the cost of going to college would explode. CBO was actually asked a couple of years ago, why didn't we see the savings from the transition from preface to direct? And a big part of the reason was these repayment programs. They made the repayment program so easy that I remember them saying distinctly that the amount of money, the amount of your monthly payment was not related in any way to how much you owed. It was how much you could afford to repay. So there were people owing $50,000, $60,000, and they're only having to pay $10, $15 a month. Or there were even zero repayments. So
rehabilitation's $5. I mean,
while you're continuing to loan out over $100 billion a year, you're not really getting that much in repayment. So that's also a reason why the size of the portfolio exploded and the cost savings never materialized.
Where's the fiscal responsibility in
For who?
for the honestly for those that are lending? right? You're lending out this capital and you're lending out 50, 60,000 and you're taking a $10 or $15 payment on it. I mean, that's an impossibility. Like that is, like you said before, Dan, it's a forever loan. Like you're just married to that now. It's just part of your life forever. And it's going to have to increase because you're never going to be able to actually repay that. So it's difficult. And there was a point in time, and during the COVID crisis, we saw some of it where there was an increase to the aggregated excess payment. It's a measurement TransUnion uses to identify how much above and beyond minimum payments people are making on loans. And that has slid significantly between 22 and 24. Like that's coming down pretty hard, which I think is an indication of what we're going to see in the marketplace. We've seen challenges as it relates to auto loans. For those of you that were at the Collection Recovery Solutions or CRS conference 2 weeks ago, I was up on stage with two of the gentlemen from TransUnion, literally walking through what some of these rates look like. And originations are through the roof at the same time charge-offs are rising. And that's why we have to really start looking at the charge-off volumes over the charge-off rates, because if you're originating at a faster pace, then your charge-off rate looks like it's fairly balanced, even though it may be increasing exponentially. But we're going to start seeing that tightening of credit. Just a couple of numbers based on that TransUnion report we were talking about earlier. Superprime went from 0.1% to 0.9% in delinquency over 90 days. You see more than doubling in the Prime Plus from 0.1 to 2.1%. And even as we talk about literally every one of these tiers, and the further down you go, is an exponential explosion in delinquencies. How can we actually get these things back on track? And Gary, as someone who's been on the government side and was managing some of this when it was still in a more fiscally responsible position, what actions or activities do they have at their disposal at this point to actually bring this back into a realistic situation?
Well, the statute says what it says, and right now everything is geared toward making it easier to repay the loans. Gone are the days when everybody was on a standard 10-year repayment plan. And if you owed $50,000, then you had to pay $500 a month. You no longer have to do that. It's just what you can afford to pay. So there needs to be changes in terms of what the expected payments should be, because again, that's how we got to this explosion. Where you have folks who, the biggest complaint that I used to get when I was with the department, even with the agencies, the borrower would call me and say, "Look, I've been paying on this thing for 5, 6, 7 years, and I owe more than I borrowed."
We hear that every day.
I'm gonna say 80% of the people we talk to are in that scenario. You'll see all the time, borrowed 20,000, I owe 27,000. It's 7 years later, and they feel like they've been paying consistently or involved with this consistently.
Paying interest only, and it wasn't covering interest only.
Or then you do a deferment, and then your interest is compiling and gets capitalized. This is that explanation. And I don't know, I guess it's two things. You can't fix one without the other. Gone are the days of a $16,000, education. That unless you're talking about trade schools or, these boot camps and things, right? Average cost for somebody in town to go to a state school in Arizona is $100,000 to get a 4-year degree, right? So, and with average income for the state being right around $60,000, that's a hunk of money.
Mm-hmm. It's 2 years.
If you
it's
did
2
nothing.
years when you add books.
So it's, I don't know, you have to fight one with the other. And I think that's how you get those schools involved, and you start getting schools reaccounted. Originally when that FFEL program came out, it was supposed to be 3 people tied to the success. It was supposed to be the borrower, the banks, and the schools. And when all 3 of those people had skin in the game, the idea was stronger, but that quickly floundered, and schools realized, I keep my skin in the game by raising the tuition and to cover these differences. And price of education is, to me, the thing. I try not to think that these loans should be as easy as they are, but
There's lots of
we're in a
things.
bad spot because of the cost.
There's lots of things that we tried to do. We brought in schools, these non-for-profit schools that came in, and they built the schools to basically work as a business, and we attacked them. We did everything we could to try to get them out of the business as a government. Not only that, what loans were forgiven? It was the trade schools. Well, now who's the next millionaires that are coming in? The number one group of the next group of millionaires are the plumbers, the trades,
Electricians,
the air
yeah.
conditioning people, the electricians. These are going to become your next millionaires, and they could go to school for things, but we belittled their degree and said, no, you got ripped off by this school that taught you how to do this trade. So well, when you take away somebody's, they still have their degree from the place, but we put out there that if you went to school at this place, you got a crappy thing and you wasted your money, and here's some forgiveness for that. But really, that's not what the case was.
Sometimes the math works against a solution. Most of the student loan volume goes to the larger schools. Okay, what we call the proprietary schools didn't have as much volume, but they got most of the attention for the problem because they had higher default rates. Where if you're a big state school and you're doing, a couple $100 million in student loans every year, but your default rate is only 2%, nobody says anything. But that 2% is a lot of money. It's way more than the defaults that the proprietary schools get, even though their rates are higher. So they don't place as much urgency. They can go out and say, our default rates are very, very low. But the volumes are so high, which kind of ties back to the cost of education school, that a 2% default rate, that's a lot of money. That's a ton of money. But then you still have to deal with, I think the biggest thing is the repayment plans. And on these repayment plans, even when people stay current for years, the balances are still growing. And they will continue to grow with these repayment plans.
So I had a comment come through that I wanted to drop out there for you guys to address, saying that we should mention that private loans are underwritten and the loss rates are plus or minus 2%, whereas the federal loans right now, in terms of delinquency, are closer to 20%. I think it's an interesting, it's an interesting paradox, I guess.
Private loans come with a credit check.
Yeah, you can be denied.
Responsibility of the lender.
You can be denied, right? You have shareholders, right? So
yes,
you got somebody that had good credit that's going on that loan when you go get it from any of the non-refi
if you're going
places.
Private, if you're going private, right? Like you're going to have to, but isn't that the type of responsibility that would bring this program back into check? And if there were credit checks or some additional requirements and underwriting on behalf of those federal loans, wouldn't that then bring the cost of education back into check?
But then
indirectly?
you're taking away the ability for people in a lower socioeconomic thing to be able to get a loan.
Right.
So
if my parents,
until the schools realize that they're short on students and they have to adjust pricing accordingly to what the market can actually bear, because an artificially inflated market will always continue to rise prices.
Right. So it's what somebody said earlier. If you have the schools or the lenders or both actually have to share in the cost of financing the loans, or in particular the defaults, they've got some skin in the game, then they've got some incentive more than they have now to be more careful about how much money they're loaning out, who they're loaning it to, and for what degrees. But then they would, again, they should have more financial support, put more of their money on the line.
Typically, they do that today.
If you're going to loan out the money to those folks, you need to be more involved with the.
Typically, they do that today through tuition discount, and they give the largest discounts to the highest performing students, because those people will, when they graduate, are going to have high success. So they're investing into the people who are going to be the most successful, oftentimes people from better economic backgrounds, so even less needy, and so they're getting those benefits. But to mention on the private loans too, though, the average interest rates we're talking to on a daily basis is between 12 and 22% variable. Even if we're talking about, yes, sir. Yes. Almost all of the originated to go to school loans are variable that we're seeing. So a lot of the refinance, even when you're doing a refinance, you have an option, variable or fixed. We've specialized in only doing fixed rate loans. We don't want these to be, we want people to be able to plan. But you go back to, you sign that piece of paper, it said it was $73. Well, that was based on the interest rate at that time. You graduate, interest rates are up, it's plus, plus, plus. And now you're looking at it 18% is my normal number I'm seeing of like the current interest rate for these students. So you take away that option for somebody to be able to afford that. And that's with good credit. So
You know,
got to
Dan
be
made a good
affordable.
point. Dan made a good point earlier when he pointed out, when you ask about whether or not these were, financially sound decisions, you will always have to deal with the question of these low income people who can't afford to go to college. Some
That's one
people
of them.
feel it's a government responsibility to help those folks go to college and to allow them to go wherever they want to go.
That
I had a
it's a key right there.
Unrealistic view of the world.
A key
well, I had a
right
friend.
there.
I had a friend of mine once who was critical of the process, and he said to me, you know, everybody can't go to Harvard. Some people have to go to Northeast, South, whatever state. You can't fund everybody, but that is the goal: is to allow these young students to be able to go wherever they want to go, and government is there to help them do it.
And I guess I understand, but I remember, I think it was Judge Smales in Caddyshack said it best, that the world needs ditch diggers too. And not everybody gets to go to Harvard, and not everybody gets to do those. I had to make I had a full ride for a state school, and I made the very difficult decision of going to a very expensive private school that I'll continue to pay for, right? Like for an extended period of time. But that was a very specific decision, right? Like I targeted that, and that was the objective. I don't know that $1.5 trillion in outstanding loans is a great way for us to manage that. I have concerns.
That's just the federal. There's 1.7 total.
Okay. Well, see, and that's why I have you guys here, to make sure that I have good and accurate information.
But your judges nailed it on the head, and that's the reason why these trade people coming out of these trade schools are gonna. I mean, I've been trying to get an electrician to help me in my backyard for 6 months, and to get one to actually show up, because they're so popular right now, because everybody went away from them. It wasn't sexy to go be an electrician. It's gonna be. But, everybody thought they had to have that 4-year college experience of having fun. And
yeah, a lot of data says that 50% of the people who graduate with a degree will get a job in a field that does not require a degree. So
I definitely won't argue that point.
the return on that, right?
Mhm.
And then you think that it's like, one of the stats was about ish% of people who start college don't finish, right? So you're only talking, so 50% start and don't finish, 50% finish and don't need it. 25% of the graduates are the people who are utilizing the degree. It's from deciding to go to school, or 25% of the enrolled.
Which, by the way, as an aside, those that start school and don't finish, and they took out loans, that's always been, and probably always will be, the biggest driver
It's
to
like a
default.
default.
Those people, most of them will default.
yes,
It's like I borrowed the money. It's like I borrowed the money to go buy a car, and they didn't give me the car.
From
So
my
and
years
then
now
of
we
doing
have
it,
this. Now we have this
I'll go back
bubble
to
of
the-
delinquency, right?
Well, I'll go back to also. Unfortunately, I'll go back and I'm being repetitive to the repayment plans. One thing we left out about the repayment plans is not just that they're easier. They have, we've had all this discussion for a long time about loan forgiveness, but these repayment plans, some of them have a loan forgiveness component to it, where you make these small payments as long as you stay in repayment for 15 or 20 years. They even propose taking that back to 10 years. But if you stay in repayment, you don't have to come anywhere near repaying the balance. If you stay in repayment for the required period of time, the unpaid balance will be forgiven. So in that sense, you've got a plan in place where it's not even expected that many of these loans will be paid off.
So now are we just funneling money into the schools? Isn't that I feel like in any other context, this would be closer. I don't know the right word for this. I don't want to call it extortion, but I feel like I can't imagine this happening in any other way. So we're going to forgive the loans, but the money's going out to the schools, which allows us to continue to lend at these higher inflated values that are not matching. And I realize that running a school is expensive, and getting good professors and facilities and attracting students and all of that is an expensive endeavor. if you make your payments for 10 years, like we're just going to wipe off the other 50, 60,000. That seems.
Yeah. And go back to what we said about the decision to borrow this money to go to school. If you're told at the time that your repayment plan, you may not have to repay this loan anyway. Don't worry about it. You're only going to have to repay what you can afford. So even if you don't get that $200,000 or $300,000 salary, you'll only have to pay what you can afford. If you stay on that plan, then it will be forgiven. I believe there were some law schools that were saying, don't worry about how much you have to borrow. The repayment plans that are in place right now will not require you to pay the entire balance if you're not able to.
Yeah, it seems like a problem. I mean, I'm not a mathematician or anything, but this feels like the math don't math. So, so hold on. I want to take us into the next piece of this conversation, because I want to make sure that we get to like our predictions on what comes next, because it's about the future pathways into how now we're here. We are where we are right now. We have this massive bubble of delinquent loans. There's a lot of accounts that need to be serviced. And if you've been on TikTok or Instagram over the last couple of weeks, you have seen some crazy videos of people talking, oh, I didn't think I was ever going to have to repay this. What do you mean they're going to start taking money from my, from my paycheck? And like, you're starting to see this kind of response, which means that there's a significant disconnect between the understanding of the borrowers and the realities that they're about to face, which means that there's going to be a lot of one-on-one conversations that need to happen. And I know, with Yrefy, I know how you guys are assisting in that kind of process of not only the education, but providing some available solutions. But a question for all of you is like, what comes next? How do we haven't been managing these student loans for so long. You've got this massive volume of accounts. It's not like you can just flick a switch and have it start operating that way. So what does a realistic plan look like for us to get back on track and help these consumers?
Realistic, or what the plan is?
Let's start with what the plan is, and then we can talk about what's happening with that plan.
Well, the plan is after 270 days of being delinquent, they're going to start putting you through into the collections, which is a big question mark, because we don't have a Gary. We don't have anybody that's trying to collect on these bills. Sooner or later, it's all going to be handled by the SBA, and rather it's going to be collected by the FSA getting absorbed by the SBA, or the FSA getting absorbed by the Treasury Department. I mean, we have 4 to 6 Treasury agencies. At the end of the last contract collecting on Department of Education, there was 23, I believe, 22 or 3. Now there's 4 to 6 collecting on 10 times the amount of borrowers. And,
but how are they supposed to scale up? Everybody, I mean, look, we saw in the TransUnion 2024 debt collection industry report that 88% of companies are having trouble hiring, 81% are having trouble retaining. So where are they going to get the bodies in those seats if they're only going to use 6 companies? Because it's starting to sound like an oligopoly.
First of all, I have no idea if they're going to do. Anybody that thinks that they know what the federal government's going to do is not, they're not being fair to themselves, because what we've seen already is if you put a plan in place, then you get in front of a friendly judge, and that judge can sit there and say, well, that's not fair, so that's going to get scrapped. So it'd be hard for anybody to go put a big, huge infrastructure and spend that money and expect that there's not going to be a wrench fell into this. And when you're spending that much money and you get clogged down, you're going to go broke quick. So what they're going to do is they're going to have to subcontract very large amounts of this and spread that over. And there'll be people lined up. I already got a bunch of people reaching out to me and I'm sure Gary probably even has more, of help me get into this next contract when it comes up. I go, first of all, there's no contract that's even being spoke to, which would lead you to believe that the Treasury, they're going to lean on those. But there are so many variables that could throw a wrench into this whole thing. I can't even speculate, because I'm smart enough to know that I don't know. I have no idea what variables are going to come into play. And anybody that is definitive on what's going to happen is very displaced on what could be going on in this world.
And I'll echo that, and I'll say what Dan is saying has always been true. Adam, you ask questions And the reason why I keep talking about history is I'm telling you, you could have asked these same questions 20 years ago. People were asking these same questions 20 years ago. It's a much larger scale now, but these questions were appropriate 20 years ago because we were on the same path. We were loaning out. We're doing just what we're doing now, but the history is pretty much the same. That's why I like to tell people and why I focus on it so much. A lot of folks just need a history lesson. And as far as your question as to what can be done, the first question that has to be answered is, what are we trying to accomplish? I will tell people, if you tell me what you're trying to accomplish, then I can help you build a roadmap. But at this stage, I'm like that. I don't know the answers. I don't know what we're trying to accomplish. We're in the middle of, we're trying to be more efficient with government, which has meant so far, we're cutting staff, we're cutting resources, we're doing all sorts of stuff. At the same time, the needs are growing. The borrowers are in a worse situation. So how do you tear it down and then at the same time come up with a better solution?
And say it needs to be better. I think that's why some of those TIBAs quit.
They
Right?
did. Well, that's
They
exactly
knew
what
what was going to happen, right? They knew that's what was coming, that we're going to be undercut. We're going to put all this forgiveness, and then it's all going to be, the rub's going to be pulled out from underneath these students, and then they're going to be staring at it and they're going to be mad. You're going to have all the oversight. You're going to have all the complaint and no infrastructure because you're not making any money. But even when you look at these companies who want to get into this today, I think people who are set up and have the right business are going to be in a position to be able to join in. But to think about building up something immense in anticipation, we've seen how one judge's swipe of a pen can change the trajectory of a whole plan laid out by a country. And when one guy can step in or one court can step in and just completely dismantle it, it's an investment I don't know that I could make today.
Fair
Well,
assessment.
What are we trying to accomplish? And I need that direction needs to come from the administration as to what we're trying to accomplish.
I think by reinstating collections 2 weeks ago, I think we're making it kind of clear on what we're trying to accomplish. Better fiscal responsibility, but that's a segment of the country is trying to accomplish that. There's no unification in the direction of what we're trying to accomplish. And unfortunately, I haven't seen that in a decade.
I think the question which a lot of people have been asking me is, what can I do to get ready? And if you're going to plan on being, obviously they're going to have to share this load with numerous different places, because there's no 4 or 5 or even 10 that could even begin to start handling this mass. And especially if you talk about the servicing, which Gary brought up to me, the other day, is you're just taking collections, Dan. What about the servicing?
Right.
Because we're doing a half-assed servicing right now. But what my suggestion would be, if you were a small agency, make sure that you're getting into with the Small Business Administration. Get as many of those certificates as you can. You got MEBs, you got Weebies, you got service disabled, and you got HubZone. And I suggest you get as many of that as you can if you're going to be a small business and try to get into this, because those are going to still probably be, how much of it, was a large part of it on the last one. I don't know with this regime, what it will be. I don't know. But I guarantee that that's probably something. I would make sure that you're getting in with as many schools as you possibly can. I'd be trying to get collections for any of the, private loans as you possibly can. Schools, whatever. I think those are going to be looking better on a resume. If we look at a fair resume, I think that would be good. Subcontracting is going to be huge, as I said, and that would be my suggestion. But for me to sit there and guess what's going to go on, I'm not going to do it, because anytime I have a bunch of people telling me what's going to happen, and I look at it and go, you don't know. You
Now
have no clue.
I'll repeat what Dan is saying. You could have said this 20 years ago. People start saying, this is what I'm hearing. Well, they're talking to each other. That's what they're hearing. And
the
best
quote of the day.
one thing we haven't touched on, Adam, either, as far as going forward. I make a big point about, in terms of what you're doing, when I talk about what you're trying to accomplish, I'm really talking about the results you want to get. What are the results you expect to get? And for all these folks that are trying to get ready to get prepared and get back into it, Nobody said anything about the fee structure and the pay. Dan talked earlier about the servicers. One of the big reasons why the servicers want to get out because they were not being paid near enough to do what they were being asked to do.
And getting fined for not
Maintain
doing it.
oversight and all those things.
Right.
Yeah.
So a big anticipation going forward with this is whether it's the servicing piece, which is the vast majority of the 1.6 trillion, or the default stuff, even with those treasury contracts, it's okay, what are we going to get paid to do this? Is the fee structure going to be enough to where we will actually get results? And I go back to what I said about the Office of Federal Student Aid, which was a performance-based organization. We were allowed at that time to put fee structure in place, to put incentives in place so that we drove real results. I really felt like when I was with the department, I had the best job there
Collecting
because
money.
it was one of the few places in all the federal government where results mattered. Not just did you follow the rules, it was they were looking for us to produce revenue to get people back in repayment. And that's what I reported on every year. So one thing is get back to the point where results matter. And not just how many of this are we doing or how many actions here are we taking? What are results we getting? And
Quality over
I
quantity.
don't know if they've gotten there yet.
It feels like there's a quality over quantity need here. And if it's just, are you checking the boxes versus are you actually accomplishing the end objective, are two very, very.
And that's always been one of the things that government folks grapple with. I told the guys earlier that some of the best people I ever worked with were in the federal government, but it's more policy driven than it is results driven.
So I guess I kind of apologize for anybody that tuned into this expecting some definitive answers because we've made things clear as mud for you.
Right.
But I believe that is probably the best advice there is sit back, relax, and be ready. Get yourself ready.
Having infrastructure in place, having the tools in place. Nobody's got the answers right now. And I think, just based on the individuals that I truly respect that have been commenting on this, I think it's a timely conversation. And I can't think of anybody better to have this discussion with than the three of you, because even just in preparing for this webinar, I've learned more about student loans than I ever thought I needed to know. It's a unique asset class in our world, right? From a debt collection perspective, it's got its own life, and it's very different because it doesn't follow the same rules as other, let's say, performance driven lending programs. And with all of the data that we're seeing, and I'm more than anything, I'm concerned for the consumer and being able to bring you guys together to have a discussion about what this realistically might start to look like. Restarting something this size at scale is a very difficult process, and to do that at the same time that you're cutting staff and shrinking the footprint of an organization while asking it to handle exponentially more volume. We did have one comment that I'll kind of mention in my closing here about when we're talking about the growth and where are they going to hire the people, it's also about the automation. And I think that the automation will play a long-term role in servicing these accounts. However, right now you're going to have a borrower base that's boiling over, and they're going to want to talk to somebody. Even the younger folks that generally originate their loans online and prefer digital channels. I think in this instance, with the level of complexity related to student loans and the repayment options like we've talked about being plentiful, people are going to want to get on the phone and talk to somebody. And I'm hoping that we can staff those phones with the appropriately trained individuals to provide that assistance, because people might hate debt collectors, but we are the last line of defense, not just from a fiscal responsibility standpoint, but for helping these consumers.
And the important thing here is too the outreach that occurs there with the servicing component. Like, I don't think what's going on right now, there's not a lot of outreach. Just kind of sitting there waiting for people to call and ask for help. We need that outbound effort, and we need folks who are actually searching for and getting these folks on the phone and talking through their options with them.
Agreed. Gentlemen,
Totally.
I cannot thank the three of you enough for coming on and having this conversation with me. This has been a fantastic session. I hope as we learn a little bit more and we can maybe come back and look at some of our predictions and our thoughts 6 months from now and kind of reconvene this discussion to see how this has continued to evolve. Because what we're talking about today is going to have a direct impact on consumers all over this country. Millions and millions of consumers are going to be impacted here. And I think it's important that we continue to have these conversations and stay on top of what is actually happening in that world so that we can adjust accordingly.
Look forward to it.
I
So,
agree.
gentlemen, thank you so much for coming on today. I really do
Thank you, Adam.
appreciate all of your time and insights. You guys are fantastic. I can't ask for
Thank
better
you.
guests.
Thank you.
Thank you.
Thank you.
For those of you that
Bye-bye.
are watching, we really do appreciate your time and attention today. If you have any additional questions, comments, you can leave those in the thread on LinkedIn here. This LinkedIn live video will be up, and then we'll be posting a replay to YouTube later in the week that you can share with your friends and anybody else that you think needs to hear this conversation. But until next time, everybody, thank you so much. We'll see you all again soon. Bye, everybody.